Welcome back. We are talking about the pre-divorce business valuation playbook, avoiding financial fallout. And with me today is guest expert Gabriella Martinelli. She's a CDFA who primarily works with business owners. So if you're divorcing with a business on the line, the stakes are high, and one misstep can cost you more than just money. In today's episode with Gabriella, who is the founder of Ever After Wealth and has over 2 decades experience helping entrepreneurs protect what they've built. So today we're going to unpack the essential pre-divorce steps every business owner must consider in order to safeguard your assets, clarify your business valuation, clean up your books, and avoid costly mistakes before, that's the key, before lawyers and courts are involved. So if you're a business owner contemplating or preparing for divorce, this conversation is your financial lifeline. Welcome, Gabriella.
Hello, Karen. I'm so excited for this conversation. I'm honored to be here, and I'm looking forward to this conversation.
Yeah, and I love that it's more nuanced. Journey Beyond Divorce has over 420 episodes out there, and there's a lot of CDFAs that are spoken to, and we've covered similar content over and over. And so this is specifically for the business owner. And you and I were talking offline, and you were saying there's all types of things that go into valuing a business. And so the valuation needs to be prepared for, and it also highlights everything. So let's start with, what are the various elements that a business owner needs to be considering once divorce is on the landscape?
So one of the biggest thing is who owns the business, because if you have a couple, right, if one of the spouses is the business owner, that business will be part of the marital estate potentially. If you grow the business during the marriage, yes, that's an asset. It belongs to the marriage. So it belongs to your spouse as well, as a divisible asset, if you will, right? Is not, a lot of my clients are like, well, she's not the owner of the business. No, she's not. The papers say you are the owner of the business. However, this business is part of your marital estate. It's going to be divisible within the marital estate if you created the business during the marriage. So one of the biggest things is, okay, who owns the business? So, because if you have spouses that are partners within the business, well, that changes the conversation as well, because now you're not just potentially dividing an asset that is a marital asset, but you also has a partnership, right, interest as an individual, because you're part of owner of this business. And that creates a lot of other conflicts and other layers of complications, because like I work with a lot of physicians. A lot of the times doctors work with their spouses that are doctors, and they open a practice together. And a lot of the time there's no operating agreements. There's not really a clear understanding who does what, how is this business really working. And that is the biggest concern here is, okay, let's identify who is the business owner, and we go from there. Because as a business owner, you need to get your business ready for this big, complex process you're about to start if you're going through a divorce. And a lot of the times the basics, hire a bookkeeper and make sure your books are in order. I cannot tell you how many times I start working with clients, and when I start looking at what they think is their books and they're excellent, and I'm like, I cannot make up anything out of this. I could not even tell you where your revenue is. I don't know where your expenses are. And by the way, do not pay for personal expenses or family expenses through the business.
And I think that that's a real key too, because especially if you're running like a small business where you're a solopreneur, it's just you and your spouse. I know when I started my business, I'd be like, oh, we'll throw that on the business credit card. So obviously people do it. Can you explain? You were just so adamant. So why? What's the big problem with running a couple of things through the business?
So you're doing this because of course it has tax advantages, which is great. As you're running a business, we all have to take advantage of those little nuggets that we can get, right, to beat the system, if you will. But the problem with that is that once you're going through a divorce, one of the biggest things you're going to have to identify is when you try to identify the value of your business, what are your business earnings? What are your business expenses? And then on the flip side, you're going to have to look at your marriage and say, okay, what was the lifestyle during the marriage? Where were the expenses for the family? Because I get child support calculations, support calculations. So the problem with that is then we have two issues. We're looking into the expense of the business, and the one person said, well, that was for the vacation we took. Like, yes, there was one work meeting, but we went on vacation. So that, what is that? Is if it's a family vacation, you really need to clean that up from your business, take it away and put it back in the column that goes with family expenses. Because otherwise there's this all mixed up. Phone is one of the basics ones, cell phone. Everybody pays a cell phone. Sometimes the cars are registered under the business. So when you're going to analyze a business and you look at the assets of the business, the earnings of the business, the cash flow, and the debt, well, the debt is going to diminish the value of the business. But if the debt was incurred because we pay family expenses, that has to be clarified, because it's not a debt of the business. It's literally a family expense. Right.
And if it's paid under the business, then this quality of life you're living isn't actually shown in your family finances because you're not spending all that money through the fund. Oh, okay. So
exactly.
So now we're in this murky pond and nothing is clear or clarified. And so is there an upside for either party, the business owner or the spouse of, to keep the books dirty?
Okay, so there is a misconception, I think, that having that will have some kind of advantage on the divorce side for the business owner. Okay. I don't think that is correct, because when you don't take in one place, it's going to be taken on the other. I'm a numbers person, and I always tell my clients, numbers don't lie. It doesn't matter where you put them. They're going to be there and they're going to tell a story. So you have to be very careful, because the other problem is, if your books are not right, if you can really show, okay, well, this was the family expense, this is true business expenses, this is something that really the business has as an expense, right? If you can't really be clear on that and show your books, that goes to credibility. So if I'm working with a business owner that is trying to be very resistant to show the books, or they don't want to, or they can't give me clear answers about what is this number, I will start getting suspicious myself, and I'm going to be, well, I'm on your side, I'm advocating for you, but if you don't give me the information, I can't help you. But also the other side is going to feel the same. A judge will feel the same, right? Because why you're trying to be a little sketchy about this, right, then you should know your numbers. Like your business, you should know your numbers. And I sometimes I don't think that is done maliciously. I don't believe that everyone out there is like, oh, I'm going to take advantage of this. I think that they really don't know or don't understand, right? Because there's so many components. I've been doing this for 22 years, and I always try to explain to individuals, divorce is like this one thing. It's like nothing else. It has its own rules. It has its own laws, that anything that you ever done in your life, or any financial decision or other type of decisions that you made, you can't make them the same way going through this divorce, because there's even basically the business valuation. There is a really misconception about, I'm going to get someone, a broker, and I'm going to tell them how much I can sell my business for. That will be the business valuation. Well, that is not how divorce looks at your business valuation. The business valuation, when you hire that expert, they need to understand it's because of a divorce. You don't value a business the same way when you're going to sell it or when you're going to go through a divorce.
Oh, tell us more about that. Yeah, that's interesting.
Right. The court doesn't look at it. Okay, if you sell the business tomorrow, how much you get. They do that with the house. They can, and even with the house, how many times you get what the real estate agents call a comp, right? So you get like, oh, well, this house can be sold by this. And then you get an appraisal and the value is totally different. Because there's so many other components when you're going to sell a business. Is anybody want to even try to buy this type of business? Is it really in a high demand to own this business? Is your business really making enough money that an investor or someone else will be interested? That fluctuates the business. When you do the business valuation for a divorce, is a true value of the business based on what the business brings as an income, expenses, assets within the business, goodwill, right? Because if we have a business like you have, like I have, a service business, there's goodwill in this business, which is look at it very differently when it's going through a divorce. And by the way, it's looking at it very differently on different states. Some states consider goodwill marital asset, is a marital asset. So it all goes in the box. Some states don't. So when you do a business valuation, that goodwill is a discount to the value of the business because the goodwill stays with the person, not the marriage. So when you look at the business valuation because of a divorce, you don't really look at who's going to buy it. It's like, okay, let me see how this business operated like 5 years ago. How do we think it's going to operate the next 3? And that's our value as an asset in this marital state to be divided. It's not something that you're going to sell. It's something that you have. It has a value in itself because of the revenue, the assets, and all of those things that come, and the goodwill that come all into account, right? So that's very specific.
I don't know if this is the right time to ask this question.
Okay.
You talked about being a sole owner or owning the business with your spouse. So what if I have a family business that my great-grandfather started? And so it's much more than just me and my spouse. Now, I know we're just talking about this first piece of cleaning up the book. So I don't know if this is the best time for me to ask the question, but I want to throw it on the table.
We can, because I think it will have something to do. Let's pretend, yes, your grandfather started this business. Then you started working in the business. And then maybe you brought your spouse into the family business, right? Because it's family.
Right.
Well, that is going to make things a little bit complicated because first of all, is grandpa still is grandpa's business still grandpa's business and you work for grandpa, or grandpa somehow gave you ownership of this business? Did grandpa give you ownership, or both of you ownership as the spouses
Or
of
me
this
and
business?
my siblings and all of the
Everyone. So there's like a 25% of everybody owning part of the business. And I'm telling you, I worked a case that it was so complicated. And she was the daughter of the owners or a very, very well-known chain in North Carolina. She owned 33% of this big company because that stake was given to her. She didn't work in the company. Just that they was given to her because she was the daughter. It was the brothers. It was everyone. And the problem we ran into that was because we needed to value that business in order to understand what her 33% was, because she acquired it when she was married. So that means that 33% of ownership in a family business that was running for the last 35 years or longer is part of the marital estate. So now you're interfering with everyone because we need to see tax returns for a business. There was 6 or 7 other owners with little pieces of ownership. Like it was, yeah. And that is the problem because, and I understand, you don't go through your marriage thinking one day I'm going to split up and we're not going to work and we're going to go, right? However, I always feel like it will be very important for people to, every time you have to make this significant decisions, is this going to protect me if this ever happened? Because it's like almost like having car insurance. You don't have an accident ever, but you do have car insurance because you're protected. And I always feel the same way. It's like, okay, if you're going to do a very significant financial transaction during a marriage, I think you should protect yourself just in case. Well, protecting your spouse too, by the way. Yeah. Everybody can be protected.
And I think that because you and I live in this world, we like know how important that is. But for the average couple who's blissfully living in love and doesn't know that 6 years from now we're going to be fighting with each other, it's such a good point. And yet it's almost like how do you communicate that to all of the happily married couples who are like, that's ridiculous. Why would I ever even think about that? And I love your insurance analogy because it really is. It's like, are you covered? That's really the bottom line. Are you covered? So, okay, we've got one spouse owns the business. And then to your point, if it started before the marriage. And then, so if I started a business, I got married 10 years later, it's like all of my other investments, right? For the value of the business, the day of my marriage, to the value of the business, the day of whatever that timestamp is, that added
Yes.
value is marital assets, just as if, you know, you
Yes.
had an investment account, same thing.
Same thing.
Beautiful.
Retirement account, the same thing. Yes.
So,
Because let's not forget that it's not just only about that. In some states, because every state is very different. For example, in North Carolina, the day that marks the end of the marital assets, if you will, the portion is on your date of separation. So I have a lot of clients that are going through this process 2, 3, 4 years on the road, but everything goes back to that day 3 years ago. Well, what happens is that when you're getting ready to go to court or finally a mediation, or you're trying to resolve, you need to do a new business valuation, because that business probably grew or the value decreased between date of separation and that day. And you need to know what that number is on the passive end, because everything earned or whatever grew because of the goodwill of the spouse that is working in the business, that is separate property. But you
right.
still need to know, because if the business has assets, there's sometimes they have real estate, like the business owns the real estate, but that's two separate pieces. So the business, until you're done, the business is always moving, and you always may need to update that value. That's why you need to continue to keep your books and be very specific and clear onto how we're running this, what are the numbers, how we're going to apply the numbers, because you can, if you don't pay attention, create more issues down the road too.
So I just want to summarize that piece. So separate property is what you own before the marriage. And in your example, from the date of separation to the final divorce is also separate property. And that's why
In North Carolina.
in North Carolina. And so for the listeners, the business owners tuning in, you want to find out in your jurisdiction how that works so that you're clear on what timeframes are separate property versus marital, and so that you understand the importance of getting an updated business valuation if that's going to help you protect some of your separate property.
100%.
Beautiful.
100%. Yeah.
Okay, so the first thing we're talking about here is cleaning up the books. And I feel you, because I'm like, my books, I felt like such a big girl when I finally cleaned up my books and stopped like paying my groceries off of my business credit card and what have you. And some people, and I know this from the work I've done, some people never really clean up their books. And now it's the divorce, and you have to, that's a big, heavy lift to go in there. Now, just for those listening who are like, oh, shoot, how many years back do you have to go cleaning up the books?
I will definitely go at least 5 years. Definitely at least 5 years. And it may be a little longer, because the problem that we're having here now at this particular moment in time is 2020. 2020 changed a lot of the businesses. So a lot of businesses were down. Some businesses went actually up, depending on what type of business it was. So it's really hard for someone to go do a valuation and use 2020. 2020 is a year that we can't really take too much into consideration, if you will. So you need to go back a little bit longer. So sometimes I tell my clients, I want to see 18 and 19 to see what the trend was those 2 years. Then you have 2020. Then let's see what happens since 2020. So then we can figure out whether 2020 did anything or it went back to normal after 2020. That's something that we need. In this particular case, we need to consider that. I think as the time goes by, 5 years will be fine. But right now, 5 years is 2020. So
right.
Yeah.
And so I'm so glad you said that. So 2020 is just this oddball year. And I know people who lost everything and people who like made a killing. So it really is quite the oddball year. Okay. So that's the books, folks. You want to understand your books. You want to know what your separate property timeframes are. So we've cleaned up the books, Gabriella. What's next?
So what's next is we need to have a very good understanding of the income, the payroll, the distributions. How are you getting paid? Because let's remember this. If we have the one spouse that is the owner of the business, more likely, not always, I had cases that it wasn't the case, but they may be the breadwinner. So the support is going to come from this income that we're receiving from the business, right? So you had to be very specific. And I had some clients that actually had multi-million-dollar businesses, and I came to find out they were not paying themselves income. They were just taking distributions. They were not even operating as an S corp for tax purposes. And I remember I was like, what? Like, we need to, you have to change this, because first of all, it's a really bad idea. You need a CPA to begin with. And second of all, how are you going to justify this is my income when you're just pulling through, paying everything, and you don't have an understanding again, what are the expenses you're paying for your family through your income? Because that's going to make a big difference. So it's very important to understand, okay, what is the W-2 income that maybe the owner is receiving from the company? What are the distributions? How are the distributions given? Because that's another part of this. If you had the last 3, 4 years, 5, maybe 10 years, you have your business, your family, and you're operating as a family, right? Like we were talking about, we're all happy, we're a family, we have a plan. And yes, we take $50,000 here and there from the business as a distribution, but then suddenly there's no distributions taken on the same amount while you're going through a divorce. That's a red flag for anyone that looks at this, especially when they're looking on the other side. So you cannot really make those drastic changes. And the only way to avoid that is understanding what were you doing? How were you operating your business up until this time? If you had to make changes that make sense, you could potentially do that. For example, that one client I work with, it was millions of dollars they were in revenue every year. And they never operated as an S corp. They still were running taxes through themselves. I'm like, okay, that is a really weird idea. I don't know why you're doing this. You need to talk to a CPA. And it was changed during the process, right? And it was a little bit of pushback on the other side. But the reality made sense. It was not helping the business to run the business that way. So we had to do a lot of cleaning, a lot of explaining. So that's one of the things. You had to be clear. How are you operating your business from the income, payroll perspective? From how are you taking distributions? When are you taking distributions? What is the operating manual? Like, how are you making these decisions through the business to take these distributions? And there's one that is big. A lot of the times, because we are in this family and we're all together, we have the spouse that doesn't work in the business collecting payroll from the business. So they are in your payroll, they collect money, they get a W-2, but they don't work in the business, right? While we're all together in this marriage and we're all going through the same thing, it makes sense, right? Yeah, put me in the payroll, I get a paycheck, we get the tax break, everybody's happy. And I'm collecting Social Security, I'm contributing, blah, blah, blah. Of course, that's the best plan ever. But the problem is, because this is the other issue. While you start the process, you cannot change the status quo. So you still have to pay. You can't put your spouse on the payroll. And if you do, I promise you, they will file right away. And the judge is going to say, she's been in the payroll for 15 years. She stays there for a minute, or he stays there until we figure this out together. And that is a big shock for my clients sometimes, because divorce is emotional. As much as we want to say it's not, it is. And as much as a business is a transaction and those decisions are transactional, they're not. It's a divorce. So the least thing you want to do as a business owner is continue to pay your soon-to-be ex-spouse while they don't do anything in the business. And you're giving them a paycheck. And sometimes on top of that, you're paying support, because that's how it works.
So I want to ask you, great point. I hadn't thought of that. I was actually going to ask you about the opposite. I've had this numerous times where my spouse was, I think, always the wife, and my client was the wife, and they were working in the business. They might have, like, one woman was actually the CFO. She was running, never got a paycheck.
Oh, yeah.
So she was just like to help. And I just actually started working with someone last week, built up the whole business, developed didn't get paid for anything. Now, I know we're talking about business valuation, but I see you shaking your head. My listeners don't see you shaking your head. Talk to me about that. Are they just shit out of luck?
Well, no, I think that is something that has to be brought to the table. So I see that sometimes too, because I work with business owners. A lot of the times I get the clients that are the spouse of the business owner, because I know what to tackle and what to look for. So I do work with both of them.
Yeah.
And when I'm on the side, that is the thing, because there's a contribution. And a lot of the times that's something that has to be brought to the table as a leverage, as of the fact that, yes, this person, and most of the time, the law will not include that contribution as in you're entitled to more, basically, because of your collaboration. Because in reality, the business was built during the marriage. You're still entitled to a portion of this business regardless. But I think that's the emotional part of this, is like, how are you going to recognize that my work also contributed to you building this, right? Because that happens so much. And I think it's very sad sometimes, because it's true. It's like the stay-at-home mom is the same way. You put all of the work, all of the tears and the stress and the tiredness and everything you do for your family, you're contributing to create whatever is at the end of the day financially is created. And I think one of the biggest pieces is that a lot of individuals feel like that is not recognized, is not taken into consideration. And I think it's, from an emotional perspective, I think it's something that has to be brought to the table. And I think sometimes it depends on how you phrase something when you're going through this process. I had a client, she was the business owner. The husband didn't work on the business, but she was able to grow the business because he helped a lot at home, the kids. Now they were all grown and stuff, but her business was very successful. And I remember being in mediation with her, and he came back, the mediator, with, he wants X amount of money from the business because he contributed to the business and he wants the business. And she lost it, right? From an emotional perspective, this was her baby. And on a intellectual level, you could say, yeah, he helped me, but this is me. I put the hours. When you run a business, you put the hours there. And it was about the phrase. And I did tell her, I said, okay, let's find a way to give him what he wants without saying he's getting your business. So when I'm on the other side, I would say the same thing. Don't ask for the business, because you know that is going to hurt them. They're not going to want to give it to you because that's their precious thing, whether you help them or not. So what I try to do is think of it strategically. It's like, how is that ask going to fall there if you ask it differently? Maybe you don't even say the word business. Maybe we don't mention the work that you did in the business. And I do know, when you're going through this process, we want to be recognized. Like, we want to be, everything has to be made right in a sense during this process because of how we were wrong or the work we put and nobody recognized. Divorce is not the time, because that you're never going to get that from the outside. That's something that has to come from you. And that's why it's so important working, right? Your divorce coach, everyone that works with you, because you can get that recognition. So I know you can take the emotion from the divorce transaction decisions when it finances, but let's be strategic. Let's find a way to present this in a way that you still feel validated without them saying it and you knowing it. We don't have to put it out in the world. And I think that is so important, especially for the spouse that is on the other side, the one that actually put a lot of the work that you can see.
So I want to ask you something though, because so I hear what you're saying, and yet let's imagine that we're talking about a high conflict case where the business owner is my way or the highway. I'm uncompromising. I don't care what you did. I don't see you. I don't hear you. I don't recognize you. If we're just looking at the law, so not speaking to his or her heart or getting, is the spouse who spent time in the business on the short end of the stick in a situation like that, like just based on the law?
Most of the time it is. But I will tell you this, I wouldn't look at it, still wouldn't look at it like that, because all their efforts made a contribution for the business to grow as much as it did. So when you have that business valuation done, all of that effort will be included in that value. So when you're getting that asset, the business divided as part of the division of the marital assets, your contributions will in a way be accounted, because potentially if you didn't work in the business with him or her, the business may not have grown this much. So your efforts are still there because it's going to add value to the business. So you have to look at it. I contributed to the value of the business. So that's why the business has X value. And it will be divided. You can't go around it. You are entitled. to a percentage. So
I
I would
really,
look at it like that.
yeah, I like that perspective because it can feel so frustrating otherwise. And so it's like if you not paid, but having this big impact, then the
Yeah.
business is going to have more value. And if the business has more value, you're getting more. I hear that. All right, we're going to
Exactly.
take a short break and then you're going to let me know what comes next in this process. Divorce can feel like landing in a foreign country without a map. You don't know the rules, the language, or where to turn. Imagine instead having a GPS, a trusted guide, vetted local experts, and a community that truly gets it. That's what the Divorce Support Network is. With DSN, the confusion disappears. You know exactly where to start, who to trust, and what steps to take. Every answer, every expert, every resource you need right at your fingertips. Go to divorcesupportnetwork.com and grab your free gift today. Divorce feels like an overwhelming, perfect storm as you navigate pain, fear, and confusion while struggling with unfamiliar legal procedures and the pressure to make complex decisions that will impact the rest of your life. Our free Rapid Relief Call provides the clarity and confidence you're yearning for. Visit rapidreliefcall.com for support and guidance today. Okay, so we're back. We've looked at the books. We've evaluated ownership and income and distribution. So that's starting to look clean, right? I guess the numbers, the spreadsheet's starting to clarify a bit. What's the next thing? And actually, before you even do that, one of the things I was reading in your notes is like, do this early, do this pre-divorce. And so what is the benefit of doing this before you're in the thick of negotiations or in court?
Because you're going to come to the table with clarity. Because all of those things I mentioned, what are the expenses? What are the expenses for the business? What are the expenses for the family? What's the income? How are we running this business? What are the assets that the business own? What are the debt? Is the debt really business debt or is personal debt because it's part of the family expenses? So when you come to the table, you're clear on your numbers. I think one of the biggest problems with individuals, especially high net worth individuals, is that they come to the table and have no idea what the numbers are. And you can make decisions without knowing, and it gets so messy because the emotion starts running high. Someone wants one thing and the other one will, and then if you have younger kids, it gets really messy because it's just, I've always feel like if you have a clarity on the numbers, this is the business income, these are the expenses, this is what I think the business, this is what the business had revenue the last 5 years. We don't have a valuation, but we have clarity on the actual numbers. Then you come to the table differently, and the other side will look at you differently too. Like I was saying, credibility is key. And if you have messy books that somebody's going to be looking at like, we have no idea what this is, and then the answers are not as clear as you would want, that is going to create more conflict. And it's going to take longer. You're going to get more. When you do a valuation and the books are not clear, guess what? Your business valuator has to clean them up for you and apply those discounts and look at what are the expenses that they think they're personal expenses and they're not busy because they're just guessing at that point. So then you don't know whether you have a true valuation. It could be better, it could be lower, it could be higher. You will never know. It's just because you have all these people trying to help you fix something that if you did it ahead, then you just come with clean books to your table, and having clarity and cleanness, if you will, in the numbers, it changes everything. It changes, and you can negotiate better.
Yeah, and I'm hearing two things. One is emotional reactions are going to go up if the books are a mess. And then if you've ever gone to buy a used car, as soon as you see the first ding or scratch, all of a sudden you're looking for every imperfection you can find. And so I'm hearing two things, like clean books keep people from having distrust and starting to look at every bloody nuance there is. And it elicits trust. It elicits a level of trust. Even if you don't trust the person, it'll keep that emotional reaction down because somebody is being transparent. The business owner is being transparent. They're being clean. It makes sense. They've already invested in the professionals.
Yes, exactly. And I think that is key. And is going to prevent also, there's this It's almost like a joke, but it's really not a joke. We call it sudden income deficit syndrome. Every business suffers of that the moment the divorce starts. And I say that to my clients all the time because the first thing they say is, no, the business is not doing well. The business started going. And I'm like, okay, let's just clarify this. That's not gonna fly. That's not gonna happen. And on the other side, when I work with the spouses, they're like, but no, he's telling me the business is not making any money. And I'm so, okay. Again, it's this syndrome that
What did you call it?
every business goes through. Sudden income deficit disorder. So it happens every time.
100 times. Yep.
Yes, it's every time. Like, even if you're looking at numbers and their sales went up or like whatever, they still tell you that. And I'm like,
Right.
you have to change that narrative because it's not helping you.
Right.
Because if you come to the table saying that is going to put up a wall immediately. Yeah. And it's going to be wait a minute, we went to Europe every year for the next 15 years and now I can't go on vacation because the business is. Right. So I think that is also part of why you need to be clear on your numbers and come to the table honestly. I will tell you this though, and I always also take this into consideration, and I'm not really defending or attacking anyone because divorce is complex. I went through a very complicated divorce and I've done this for 22 years. Divorce gets very complicated. It becomes emotional, but there's something that we always have to keep in mind. The business owner is emotionally attached to the business, right? Because it's our thing, especially if it's a smaller business that you created from scratch.
Baby.
Almost like the mom usually is attached to the home, right? Like there's just different emotional things there. So there's that part. So they're going to try to protect it because the emotions are going to ride high there. And at the same time, you're going through a divorce. A divorce is emotional and is overwhelming and is scary for everyone around. It's not just the women, it's also the men. It happens to everyone. We show our emotions differently, but they are there. The fears are there. Me working with both male and female, and I can see the same fears right there. They're just coming out differently.
Exactly.
So sometimes I tell them to be careful because I think the business sometimes suffers because of the divorce. It's a true thing that the business may suffer because if you are the face of your business and you're going through a very complex divorce, you can't be the same person. It's just we're human beings. We can try.
You're not on your A game. You're just not
exactly. You can. You just can't. So you need to be, but it's a very fine line. Okay. We cannot go through the other side either. We just got to acknowledge that and know that there's still room to continue to grow when this passes. I tell my business owners all the time, listen, I understand this is hard, but you're going to pass through this. This is going to get over. You're going to continue to grow your business, but we need to pass this through now. And we can't use that excuse as in my business has no value.
100%.
So that's something else. Yeah.
Yeah. And I think that so often I work with the business owner because it's so hard to stay on your A game. So at least if you've got a divorce coach in there and you've got a sounding board and someone who's helping you to go from reactive to responsive and tamp down and how important is it and pick and choose your battles. For me, the entrepreneurs that I work with, it's so vitally important because you're going to be paying for the family going forward. You have to keep the income up. And yet you're in one of the most overwhelming transitions of your life. And so it's so important to have someone like you, have someone like me, like have the team that's going to help you at least do your best through that process. 100%. Yeah. Okay. So we've covered a number of things. We're going to have to wrap up soon. What's left? What are the other key pieces?
The next one is the business valuation. So you're going to pay an evaluator to do a business valuation. A lot of the times we get two, each side gets one. Sometimes they agree on one from a neutral evaluator. That it gets tricky because someone may get disappointed. And sometimes there's a weird perception that the evaluator is going to go towards the owner of the business because they're going to have more conversations. So sometimes I'm like, okay, let's get each one. Now, when it comes to the business valuation, you had to be very careful too. Who is going to create this valuation? Not just because it's a divorce, right? So you look at the calculation differently, but also you need to understand how much experience this valuator has with your business. Because if you're going to evaluate a medical practice, you need someone that understands how medical practices work, because that's what's going to help them come out to the true value of this business.
100%.
And what I do with my clients is I tackle those valuations from both sides, and I find issues usually with the valuations. And then I have conversations with, if it's my client, with their evaluator, and say, okay, why do you use this number? Why are you doing this? The other side, I do the same thing. I can't talk to the evaluator, but I will point out things so the attorneys can handle. I had a client, he had a dental practice. He brought me the valuation from the other side. All of the comparative dental practices they use, they were in California and we were in South Carolina. And I'm like, okay, that makes no sense. Like, how is it they're using a practice that is on the other side of the country to put a value on your business? So those little things you had to pay attention. And that's what I really do for my clients. I'm going to tackle this business valuation. I'm going to find issues so we can go back to the experts and say, okay, let's fix this, because we need to come up with a number, because the evaluator is going to have to, if they have to go to court, they're going to defend their valuation. So I want to make sure that if it's my client's evaluator, they are set on the numbers and they use the right numbers so they can win. And if the other side, I want my client's attorney to have enough ammunition to poke holes if the valuation doesn't make a lot of sense, because it's going to be key.
Right. Who chooses the business valuator?
So a lot of the times attorneys have their business valuators they work with. I have a lot of business valuations contacts because of the different type of businesses. So what we do is, if I'm working with my client's attorney, I'm like, okay, I have these two suggestions. Who do you suggest? Some attorneys are very open to working with me. We kind of work together, brainstorm about which one could be better. We have conversations with them. And then the client at the end of the day is the one that's going to pick, but we're going to tell the client why one or the other. So usually that's how it works, unless the client happens to know a CPA that is a business valuator and has experience in divorce. I think that's key. You need a valuator that actually understands valuations because of a divorce. Again, no selling, divorcing. So that's key.
You're saying a few things. So let's wrap up with this, because I think this would be really valuable.
Yes.
So the business valuator is going to be a key member of your team. And so what I'm hearing is, if you have a big manufacturing company, you don't want someone who specializes in partnerships. If you have a partnership, you don't want someone who specializes in retail. So the type of business you have is part of how you make the decision. Is it the size of the business too? Does that come into play at all?
Not really.
So besides the type of business and an evaluator who has experience in divorce, single and separate from their experience in businesses being sold, are there any other criteria on that short list that our business owners should know about?
No, I think that's the key. That's the key, is what is the experience in your industry, and whether they have experience in divorce and how much experience they have to, right? Because I think that is important. And I do understand and appreciate everybody starts somewhere, but when you're dividing a business, and if your business has a certain level of value, you need to make sure you work with someone that has a lot of experience, because it's going to make a difference.
What about experience? Because I have a great business valuator I've interviewed a few times, and he has a lot of experience testifying. So is that an important piece of it too?
It is very important if you think you're going to be, but most evaluators are usually trained and they are able to testify. If you hire a business evaluator, they usually understand that that's part of the job. And if they have the experience that I'm asking for, they will have experience testifying, because that's key, right? Like I was saying, they need to defend their numbers to make sure that the judge believes them and not the other side, basically, unless there's an agreement on a value.
Amazing. What a great conversation, Gabriella.
Yeah, it was great.
So helpful and informative.
Yeah, I'm glad. Yeah.
So for our business owners who are leaning in right now, going, where does this woman live and work, and how can I get in touch with her? Could you please share?
Of course. So I'm based in North Carolina. I work all over the States. I have clients everywhere. My website is www.everafterwealth.com. You can reach out to me directly through my email. It's Gabriella@everafterwealth.com. You can contact me through the website. You can send me a direct message. You can even schedule a call with me if you need to from my website, so we can have a conversation. The sooner the better.
Okay, great. All of that information is in the show notes, folks. And so if this is you, reach out, chat with Gabriella, and see how she can help
Yes.
you. And
Please.
Gabriella, thank
Yeah.
you so much for coming on, for sharing your
Yeah.
wisdom, your guidance and experience. I think that this was beautiful. And I don't know that we've ever done such an in-depth conversation around the business valuation.
Yeah, I am so glad I did it. I'm big on education, information, and I haven't said a lot of things. There's more to say. So there's like, this was just the tip of the iceberg. But yeah, thank you for the opportunity for sure. And for all you're doing for the information, informing individuals, that's for sure.
Thank you. Thank you so much.
Yeah.
And we'll be back again real soon. You have a great day. Thanks for joining us on the Journey Beyond Divorce podcast. I hope you found guidance and encouragement to help you along your journey. If you like my podcast, please take a minute to subscribe and leave a review on iTunes. You can also visit us at jbddivorcesupport.com, where our team of coaches support both men and women through our one-on-one coaching, group programs, online courses, and free resources. Stay tuned for our next episode, and I'll talk to you soon.